So, we can start and let's come back to the examples, okay? You remember that, just to summarize, in the first 3 sessions of the course we have to discuss about the framework of, the global framework about private equity venture capital. That means the fundamentals of private equity venture capital. So 4 different topics we have to discuss about. The definition of private equity and venture capital, step number 1. Step number 2, a company perspective in demanding money coming from the private equity investor. The step number 3 we are discussing about, and just 5 minutes to discuss about it, the investor perspective. And the last issue we have to discuss today, the different clusters, the different categories, the different markets of private equity and venture capital, okay? Let's come back to the lesson of last week. The problem was, okay, we are discussing now about the investor perspective, okay? So this is the issue. If you want to discuss about the investor perspective, if you remember, the problem was, is it possible to calculate the financial need, the financial gap of a company considering the time, okay, not just simply a formula, but a formula which is possible to link to the company life? And our answer, my answer was, yes, it's possible to do that. And if we come back to the formula that we mentioned in the last lesson, we said that the financial need, you remember, or the financial gap, they are synonymous, of a company in a certain time t is the difference between the usages and the sources of funds, where usage of funds is calculated as capital intensity, that means investment divided by sale, both of them in a time t, multiplied per delta sales, whereas delta sales means sale in time t minus a sale in time t minus 1, and this is the use of funds story. On the other side, we have the source of funds story, where a source of funds story means the cash flow in the time t minus 1. You remember? We start to apply this formula, first of all, in a very stupid example. Stupid because numbers are not related to a specific company, okay? You remember? We discussed about it. And second, we stop in this very moment, if it is correct, because I start to overlap the 2 classes, so sorry, I didn't remember exactly, okay, the sharp moment in which I end my lesson. And we have to move to this other example. This example, wow, we are very lucky, okay. This is a very realistic example because it's an example of a startup of a low-cost airline companies, okay? In this example, you find very simple input data, and input data said, okay, the assumption in this business plan is that a company has to buy 4 airplanes with a price of 100 million each, and, okay, in every airplane we have 195 seats with an average fare of 100 euros, just to have some very rough information, okay? I don't want to discuss. What's the problem? You see?
No, we saw it last.
Ah, okay, okay. So you gave to me the false information. It's the responsibility of your colleague. Okay. Okay, because nobody told me anything, so I start discussing about, we saw it last time? Okay, you have to tell me, okay? So, and we see this example in which, just to remember, the problem of the private equity investor is, okay, let's try to analyze what is the size of the financial needs, where the size means the sum of the financial needs, and let's give a look to the time of the financial need. Because if we give a look to this table, the information is that the company needs more or less 1,000 euros, 1,000 million euros, and it's necessary to give this money for 5 times. So the issue and the problem for the private equity investor is, what is the percentage that I can finance? And in this case, the story is not so difficult because we have 1,000 euros, but you have only 5 times to wait. On the contrary, you remember the example of the previous chart in which we said, I didn't remember, 9 years you have to wait in order that the company doesn't need yet money. It's a completely different story in terms of risk. Okay? So this is the investor perspective. What I would like to do now is to try to give a look at this table in a different perspective. Because I gave to you a definition about the problem of the investor perspective. I gave to you a table in order that you start crunching numbers. Now I'd like to come back to theory and to say, okay, this is the table about investor perspective. Let's try to say something more general in order that you can keep in your brain the theory of the investor perspective, okay? And so our problem now is to try to have a very general look about the investor perspective. So let's come back to the formula. We said that the formula is the financial need in a certain time t is the difference between sales multiply per capital intensity minus cash flow in a certain time t. Okay? So if you want to understand something more general about this formula and about the investor perspective, I don't know if you agree, but the problem is to try to identify the graph of the financial need related to time, okay? Because if the problem is the size of the financial need, how long is the time, and what percentage we have to finance, the problem is to have the graph of the financial need related to the time. Is it okay? Let's start to do that, to identify the graph of the financial need. Do you agree? We can do that? So our problem is to try to identify the graph of the financial need. Okay? So this is the last issue to discuss about the investor perspective. Before giving to you the graph, I would like that we discuss a bit about the graph of the other 3 variables, which are sales, that means sales variation, capital intensity, and cash flow, okay? If you are able to identify the graph of these 3 variables, it's possible to come to the last graph, which is the graph of the financial needs, okay? And this is the task for today. Let's start. In your opinion, what is the graph of sales? What is the graph of sales? Not of a specific company, of whatever kind of company, of course, please. In your opinion, you said, I know, you changed your mind? Okay. No, you can say no, thank you very much. Any idea about the graph of sales? It's a very simple assumption in whatever kind of... Sorry?
I suppose it's growing now.
Not exactly, it's the so-called S-curve. The classical curve of sales. Okay? Sales. Okay? In whatever kind of company, generally the assumption is that this is the curve of sales. Okay? Guys, one of the problems is not to write on the whiteboard the S-curve. When you stay in the real world and you have to evaluate a business plan, don't worry, in whatever kind of company you have this S-curve. The problem is, when you have to analyze a business plan, is the maturity of every phase of the S-curve, okay? Because you can stay or you can evaluate a company in which this is a fast growth, okay? It's an S-curve, but you are very lucky because the development, the early growth, and the fast growth are very quick, okay? And you immediately get to the mature age. That's great, okay? In other cases, you have an S-curve, but this is the story, okay? So in both cases, you have S-curve, but the maturity of the different phases is completely different. And this is one of the issues you have to evaluate when you give a look to the business plan, okay? You have to discuss a lot about it in the second part of the course, obviously. Today, in this part of the course, you have to learn about the theory. This is the curve of sales. Is it okay? Do you agree it's a very stupid model which is called life cycle, okay? But it is 100 years that we discuss about it, and it's considered a good assumption, a good model to identify the path of growing of sales. This is the story of sales. And the story of capital intensity? What is the story of capital intensity? What is the graph of capital intensity? Traditionally, the graph of capital intensity is this. For what reason? Okay? Economists discuss a lot about if it is a curve or not, but this is the trend, okay, of capital intensity. Where the meaning of capital intensity? The meaning of capital intensity is that obviously there is a decrease for two different reasons. Reason number one, the depreciation process starts in time zero. Okay, you remember the graph and the example, okay, of the airlines in which there is a decrease of investment. For what reason? Very simple, because the depreciation starts working. But second, and this is very stupid, capital intensity is falling down because of an increase of sales. Stupid but important, because this effect is called economies of scales, okay, and probably you know. So the graph of sales, the graph of capital intensity, and last, the graph of cash flow. What is the graph of cash flow? This is cash flow. In some cases, cash flow starts from a negative level. In other cases, cash flow starts also in positive level, but generally this is the trend of the cash flow. Okay, guys? Is it okay? Just to keep in your brain the idea of the graph, to have something more general than a table with number, like in Excel 5. Okay? Till now, is it okay? Questions about it? The problem is, okay, if we have these three different graphs, what will be the graph of financial needs? I don't want to create for you another graph because otherwise it's a chaos to have it on the same whiteboard. Financial need. Okay. In your opinion, what will be the graph of the financial need or financial gap, time after time? Financial need positive, financial need negative. Okay? This is the trend of the financial needs. In the first part of the story, we have a financial need which is positive. For what reason is positive? Because use of funds is higher than source of funds. And in the second part, we have source of funds which is higher than uses of funds. Okay? Is it okay, guys? The problem is, now I really need your attention, because now we have to get to the final idea about this theory. If you stay in time zero, because you are a startup financer, you have three different problems. And I would like that you understand it, okay? Because we are saying it in a more general way than tables on Excel. The three problems are the size of the financial need. Right? This is your first problem, the size. The second problem is the time. And your third problem is the percentage you decide to finance. The size, the time, and the percentage you decide to finance. Where percentage, you know that for you it's really a very complex dilemma, because if you give more and you satisfy more, you have a better control of the company, but your risk increases. because your exposure is increasing. On the contrary, if you finance a smaller percentage, your exposure is falling down, and it's better, but you are not able to control the company. We don't have a solution, okay? We don't have a solution. It's a game of negotiation in startup between the private equity investor and the company to find a compromise, okay? But please remember that you really stay in a dilemma, okay? Guys, the problem is, I would like to check with you. Do you agree that if you stay in time zero, the bigger is the size and the longer is the time, the more difficult is for you the job? Is it okay? So the higher is the size and the longer is the time, the more difficult for you is the job. And in many cases, in some cases, the job is so difficult that you say, I cannot invest. Okay? So, because these questions are very important, I would like to understand from you from which variables depend both the size and the time. Because if size and time are for you so critical, I would like to understand from which variables these two variables depend. Size and times are related to what? Or from which variables they depend? What is your idea?
Maybe it depends on the business the company is going to.
Is it too general? It's too general. I'm sorry, but too complex, too complex. I would love something. Please try to get to the point.
The speed of growth.
Sorry?
From the speed of growth of the sales, for example.
Yeah, the size and the time are related to two different issues. The issue number one, I agree with you, is sales growth, okay? Because if you stay in this story, this sort of break-even is very close to time zero. If this is the story, very slow, the break-even is quite far from the time zero, okay? Please take care about it, because it's not related to profitability of the company, okay? It's related to cash flow and sales growth, okay? You can have a very profitable company where sales growth is very slow, okay? You see the return on equity and it's positive, great, but for you it's not relevant. Do you understand? Because your problem is cash flow, and if you have a company which is able to generate profit, great, but it's not relevant for you. Because the problem is, if the growth of sales is fast or is low, this has an impact on what? On the time. Is it okay, guys? So if you give a look to a business plan, your problem is not profitability. Your problem is to give a look to sales growth and to the impact of cash flow. For what reason? Because it's fundamental for you. Because if the sales growth is very fast, you can give a look to the table of the example of the airplane, and you see, okay, in 4 years, the company is able to produce cash. Great. Or if the sales growth is very slow, you give a look to the table and you see, wow, in 9 years the company is able to produce cash flow. No, it's not my job. But in both cases, the company could be able to generate profit. So sales growth is related to time. I would like to understand what are the variables that generate the size of the financial need. Two variables. Time is related to sales growth, and size is related to something which is a bit different. Give a look to the graph.
Depreciation.
Cash flows.
Cash flows and capital intensity. So size is related to capital intensity and cash flow. In which sense? Give a look to the graph. This is the graph of capital intensity. Do you agree that in whatever kind of company, I'm repeating, whatever kind of company in time zero, you have the maximum of capital intensity? Do you agree? In whatever kind of company in time zero, you have the maximum of capital intensity. Do you agree? It's quite obvious. And I hope that, do you agree that in time zero you have the minimum of the cash flow? Is it okay? Is a right assumption? It's not a Bible. It's an assumption, but which is quite concrete. Is it okay? So, when you give a look to a business plan, your problem, your tremendous problem is the size of the financial need. And the size of the financial need is related to what? To capital intensity and to cash flow. In your opinion, these two variables are related to the idea of Stefano Caselli, to Mr. Stefano Caselli as an entrepreneur, or to something else? It's a quite tricky question. Do you understand the question or not? Yes or not? Don't worry, you can say, no, we don't understand. What do you say? Okay, is it okay that, question number one, the size is related to capital intensity and to cash flow? Is it okay? So the higher is capital intensity in time zero, and or the lower is the cash flow in time zero, the higher is the size of the financial need. Is it okay? Yes or not? Okay. So if you want a good suggestion as a private equity investor, dear guys, please avoid business plan in which capital intensity is very high and cash flow is very negative. It's better that you finance company in which capital intensity is not so high and cash flow is not so small or negative. Is it okay? It's a good advice? Ceteris paribus, is better to invest in a company where capital intensity is lower and cash flow is not negative? Okay, and my question is, these two variables are related to the entrepreneur and to the business idea or to something else?
Maybe it depends from the sector.
Absolutely. Capital intensity and partially cash flow are not related to the entrepreneur and to the business idea. Capital intensity and cash flow are related to the sector in which you stay. If you want to launch an airline company, okay, the size of capital intensity is driven by the sector. You can be a very smart entrepreneur, but I'm sorry, you need 4 airplanes with a price of 400 million euros. It's not related to your capability and to your business plan. On the contrary, if you launch an internet company, you don't need the 4 airplane. Capital intensity is lower because you are a smart entrepreneur, smarter than the man or the woman that decided to launch an airline company. No, it's related to the sector in which you stay. The same story from the cash flow. For what reason? Because the sectors can be labor intensive or not. And if you stay in a sector which is labor intensive, the cash flow is negative. Not because you are not smart, but because of the sector. So take care about it, because the size of the financial need is driven both from variables which are related to the skills and to the business model of an entrepreneur. And you can see it in the time, and the time is related to sales growth. Okay, sales growth is driven by your business plan, by your skills, by your capabilities. Okay? On the contrary, the size of the financial needs is driven by capital intensity and by cash flow, and both of them are more related to the sector than to your business model. Okay? Is it okay, guys? Okay? I would like to check with another example. If you read the business plan of a company that would like to operate in the shipping sector, you can give a look to the business plan and you say, wow, there is a very high growth of sales. For what reason? Because the business model is okay, you are a very smart entrepreneur, the business idea is quite good, great. But on the other side, capital intensity is tremendously high. It is not related to your business model, it's related to the sector. And the cash flow is tremendously negative. For what reason? Because the shipping sector is labor intensive. And so you can find a situation in which capital intensity is very high, the cash flow is very low, and in this case, you can finance this company only if you have a very fast growth. If you don't have, I'm very sorry, but I cannot invest in it. And so you have to use family and friends, business angels, other people, but it's very hard for me. Okay, guys? Is it okay? Is it okay? I would like to give you a very short story about the usage of this graph, because in my opinion it's fundamental that you know this story and you remember it. Okay, so take care. I would like to come back to 1999. Okay? In 1999 was quite trendy, also in this classroom, in thesis, but in whatever part of the studies of economies and newspaper, to discuss about dot-com companies, okay? So it was quite trendy for private equity investors to invest in startup of internet companies, also very large internet companies. What happens? The idea in 1999 was the following. If you give a look to business plan of internet company in 1999, this was the graph of sales. So we didn't stay in a crisis, big expectation of growth of internet. So if you gave a look to business plan of internet companies in 1999, this was a good example of a graph of sales, okay? I don't want to discuss about cash flow or capital intensity, but if you have this graph of sales, the graph of financial need is the following. Is it okay? That means the size could be higher, but don't worry, the time is very short. Okay? And if you find yourself in this study, for you as a private equity investor, it's very simple to finance. Because you say, oh, give a look. The size could be big. It depends from the business. But the time is very short. Stefano needs 50 million euros and is able to repay it after 1 year. Don't worry, I give to you 50 million euros. You understand? But what's happened in 2001? What's happened in 2001? In 2001, we discovered that this was not the story of sales in internet. The story of sales in internet was this. Okay? Is it okay? Not because Stefano is not a good entrepreneur, but because the story of the sector is completely different. And what's the consequence of it? The consequence is that the company you finance is not able to get to this point because the trend of sales is very slow. And if the trend of sales is very slow, this break-even point is not here, is here, or is there. You understand? And if the break-even point is not here, but is here or is there, the company needs other money. And if the company needs other money, you have only 3 stories. Family and friends that insert other money, a lot of companies that went to the court because of a failure, and a very small number of companies in which the private equity investor decided to invest again. If you give a look to the list of companies that was listed in the stock exchange in 2000, or the name of the company very trendy in 2000, only the 10% of those companies are still alive in 2009. For what reason? For the reasons I mentioned before. But we learned from the past, so in 2009 you don't find any private equity investor that gives to you money with this assumption of sales. It was possible in 1999 because we stay in a very booming age and we didn't have crisis, but nowadays in 2009, if you give a look to the business plan and you see this trend of sales, you say, dear Stefano, it's not possible. I would like to understand more about your business plan, what are the different scenarios and so on. In 1999, no scenarios, but only big expectation of growth. Okay? Sorry for this story, but to take care and to remember, okay, the usage of this graph. Just a last remark. This graph is very important into three different clusters of private equity. And the three different clusters are startup, early growth, and expansion. Okay? In these three clusters, the usage of this graph is fundamental. In startup, you stay here. In early growth, you stay here. And in expansion, you stay here. In these three different clusters, the usage of this approach is fundamental. Because in these three stages, you have the problem of size, time, and percentage. In the other stages, like development, like seed financing, or replacement financing, the stories are different and you have to discuss. So typically the usage of this graph is perfect for the three different stories of startup, early growth, and expansion. Okay? Where the risk is falling down for the private equity investor, because if you move from startup and you move to early growth and to expansion, the risk is reducing. For what reason? Because the problem of the size and the problem of the time is falling down. Okay? Questions about it? Is it okay? Questions? Let's skip to the part number 4 about fundamentals. The part number 4 is related to the clusters of private equity and venture capital. So we have to discuss about the 6 clusters of private equity and venture capital. Okay, do you remember the names of the 6 different clusters? We have to write it because we have now to discuss about the different clusters. Please help me to remember. Class number 1 is seed financing. I don't repeat financing, but the second cluster is startup. Cluster number 3 is early growth. Cluster number 4 is expansion. Cluster number 5 is replacement. And cluster number 6 is vulture or distress financing. Okay? You remember? And remember that the first 3 clusters can be named venture capital. Okay? These are the 6 clusters of private equity: seed financing, startup financing, early growth financing, expansion financing, replacement financing, and vulture or distress financing. These are the 6 clusters, the 6 markets of private equity. Now what we have to do? Now, I have to give to you an idea about the 6 different clusters, whereas an idea, in my opinion, means 3 different stories. I have to give to you the definition of every cluster, I have to give to you the fundamental of risk and return profile, and last, I have to give to you an idea about the managerial involvement of the private equity investor. So it's not relevant only to know the definition and the risk-return profile, but it's fundamental also to have an idea about the managerial involvement. For what reason? Because coming back to the lesson number 1, you remember that a huge difference between corporate finance and private equity is that in private equity there is an involvement of the private equity investor in the company. So it's fundamental to understand what kind of involvement, what I have to do for you if I am the private equity investor. So managerial involvement. Okay? Okay, guys? So 6 clusters, and we have to point out 3 different issues per cluster. Take care about it. We stay in the first part of the course, so I have to give to you the picture. The very analytical content of every cluster we will see in the last part of the course, when per lesson we have to discuss about the different deals. And we will use a different example of deals to discuss cluster by cluster, okay? Today it's really an introductory preview in order that you have all the fundamentals that are necessary to understand everything, okay? Before starting the last issue, because otherwise my opinion is not fair for me. These 6 clusters are all important, relevant, and blah, 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 but otherwise it's unfair. It's fundamental for me that you know that one of these 6 clusters all around the world has a weight in terms of volume of 50%. So the 6 clusters are all important, but one cluster represents half of the market of private equity in the world. So in my opinion, it's fundamental that you start knowing it, and the cluster which represents the 50% of the market in the world is replacement financing. So replacement financing is the cluster of private equity, okay? 50% of the market in volume is something impressive, okay? So it's fundamental that ex ante you know it, because otherwise it's a bit unfair to study a lot without knowing that one of the clusters is very, very important. Let's start the definition. Let's start from the definition. Take care about it. When I have to give to you the definition per cluster, I have to give to you an idea about the reason or the reasons why the private equity investor gives to you money, okay? Because in every cluster it's a story of giving money. So if you want to understand the definition, you have to understand why the private equity investor gives to you money. So let's start from seed financing. What is seed financing in terms of definition? Seed financing is the financing of a research project. Seed financing is the financing of a research project that could generate outputs that could be transformed into products. Seed financing is the financing of a research project that could generate outputs. This output can be named business idea, and this output could be transformed into product. So in seed financing, the game is quite risky because it's a very long process. You have to give money to someone to run a research project. Okay? This research project could generate output, and this or these outputs could be transformed into products. Okay? A very long story, a very long process. Is so long that in very many cases, the seed financing story is not a story of private equity, it's a story of business angels, family and friends, and in many cases it's a story of endowments and charity. For what reason? Because it's a very risky story. A research project that sometimes could generate output, and this output could be transformed into product. Okay? It's a very complex story and a very risky story. Is it okay as a definition? Okay? So Stefano Caselli would like to have 100 million euros to run a research project to fight cancer at the liver. Okay. In your opinion, it's possible to find output? We cross the finger sometimes. But if you, by chance, you have outputs, these outputs can be transformed into products? And it depends, because if I find an output and I discover that the price to sell a product, sorry for the use of this language, the price to sell a product to fight cancer at liver is 2 million euros per pill, is it possible to transform this output into product? No, it's not possible. For what reason? Because it's too expensive. It's not possible to do that. So you have the output, but you don't have the product. You understand? So it's a sort of double risk you have to face. Question about the definition? Is it okay? Is it okay, the definition? Please forget very stupid stories we find on the newspaper that seed financing is to give money to someone to develop a business idea. Absolutely not. Seed financing is a story of money to finance research projects. If you don't have a research project, I'm very sorry, you don't have seed financing. You want to develop a business idea without research project? You want to start your company, your business idea? Please, it's a story of family and friends and business angels. It's not a story of seed financing. Okay? The problem now is risk-return profile. It's tremendous. It's, your opinion, is a risky business for private equity investor? Is a risky business? It's risky business? Do you want to have numbers about this risky business? Numbers are a very simple golden rule, which is written in US handbooks, but it's true. If the golden rule is named 1,110. In seed financing, you screen 1,000 projects, you finance 100 projects, and only 10 are able to generate results. This gives an idea about the tremendous rule of seed financing. In your opinion, why I didn't say, it's not a joke, 110-1, because it's the same proportion. And I said 1,110. For what reason, in your opinion? I didn't say 110-1, because proportion is the same. Do you agree? I can say 110-1 or this. Why? I used this sentence and I didn't use it. It's a problem of risk return. It's a bit tricky. Because when the risk is very high, The unique methods you have to face the risk and to manage risk return is to use a very big size. Because if you use a very big size, it's possible for you to diversify. If you don't have a big size, it's not possible for you to diversify. Okay? So if you invest in seed financing and you have only 1 billion euros to invest, your story probably is a story of 110-1. And it's not possible for you to diversify. On the contrary, if you have 10 billion, 50 billion euros to invest, your story is 1,110, and probably you will have 10 projects with success. And it's possible to diversify. Okay? So the first rule to manage risk return is big size. Okay? Big size means that you don't find any private equity investor all around the world with a size which is lower than 10 billion euros. If you want to stay in seed financing, the minimum size is 10 billion euros. Okay? In Italy, France, and Spain, unfortunately, we find a private equity investor which invests in seed financing with size of 50 million euros. It's a great idea. It's a stupid idea, because if you have only 50 million euros, you are not able to screen 1,000. You are only able to screen 6 or 7 projects. Do you agree? And if you screen 6 or 7 projects, it's very difficult to be so lucky to identify the winning one. On the contrary, if you have 10 billion euros, probably you can screen more than 100 projects. And not only if you are lucky, but probably you will find the successful projects. Okay? So big size is the fundamental to manage risk and return in seed financing. Okay? The other rule to manage risk return in seed financing is related to another issue. This is the following. Let's imagine you are the private, your name is? Maria. Okay. Let's imagine this story, Maria. I am an inventor, okay? And I'm asking to you 50 million euros because I have to finance the project for fighting a cancer, okay? So your problem is to decide if you give money to me. You are happy to give money to me if the two scenarios for you are only Stefano Caselli will discover the products, scenario number 1, and scenario number 2, Stefano is not able to find the solution. Is it possible for you to do that? It's a 0-1 scenario. Or you win, or you lose everything. Do you want to finance in this way? Do you want to finance me if you have only these two scenarios?
It depends on the probability you...
Oh, we can calculate it. 10% to find the solution, 90% I don't find. Or it's better, 1% I find it, 99% I don't find it. But it's not the right angle. It's not the right angle. It's okay to discuss about probabilities, but it's not the right perspective. My question is, forget probabilities. Is it possible for you to finance a company with these two scenarios? If you say yes, it's possible to go to the casino and to use a portfolio approach. I'm serious. If you have only two scenarios, you cannot diversify. You understand? You cannot. So it's not possible to give money to me if you have only two scenarios. But that's quite important in terms of risk and return, because you can give money to Stefanos only if you have multiple scenarios for investment. And to have multiple scenarios means that you give money to me not only because I can be able to find the solution against cancer, but you give money to me if you are quite sure that I'm able to generate minor products and or byproducts from the research project. For what reason? Because you invest 50 million euros, you perfectly know that I will not find the solution. You perfectly know. It's obvious, 1%. But you invest because you know that you are sure that I'm able to produce minor products, byproducts. You can patent it, you can patent them, and you can generate sales. And the impact of these sales is to reduce your loss, because you don't lose 50 million euros, you lose 10 millions. And or you are able, if you are so lucky, to generate also small profits. You understand? So a fundamental condition to manage the risk return is, please, you have to identify investment with multiple scenarios. Multiple scenarios. Okay, guys? Take care about it. If you don't have multiple scenarios, I'm not joking, I'm very serious, please go to family and friends, and especially go to endowments and charity. It is not possible to finance through private equity this kind of business if you have only two scenarios. Okay? Is it okay, guys? Take care about it. What happens in private equity world could be this story. Your name is Maria, right? Let's imagine that Maria would like to finance Stefano, 50 million euros. Maria screens the project of Stefano, and Maria understands that Stefano is not able to produce multiple scenarios. Only two scenarios. Or you will lose everything, or you will win. For you, it's not possible to do that. But what you can do is the following. You can say, Stefano, I'm not able to finance you because it's too risky, but I can arrange for you a meeting with a charity, okay? Or with a foundation. And you give a call to, your name is?
Cindy.
Cindy. You give a call to Cindy. Cindy is the manager. She is the manager of a charity. You organize the meeting. And Cindy say, okay, Stefano, I give to you 50 million euros because I'm looking for a social return. It's not relevant for me profit. Let's imagine the story. And if by chance, with the 50 million euros, I'm able to find the idea, what will happen? Will happen that 10 years later, I will come back to Maria and I say, Maria, as you read on the newspaper, for me it was possible to find a solution. So thank you very much. But now I have a business and I need capital from you to launch a startup, or I need money from you for early growth and expansion. You understand? It's a story of networking between different players that help each other. It's a typical story of US and UK. In Europe, our culture is different. Because Maria says, Stefan, I'm very sorry, I don't give to you money because 50 million euros, no, it's too much. Maria, but you know someone else to... Stefan, I have no time because I have to screen other projects. Please, find other people. Okay? This is European story. The typical European story. We are not able to manage networking, okay, between different institutions. It's completely different in the tradition of UK and US. I don't want to defend UK and US, but in this case, networking is higher. So let's come back to this table. Sorry for the time, but seed financing is not an obvious definition. In other clusters, stories are very simple, but in seed the story is not simple. The last is managerial involvement. So if you want to manage risk and return, big size and multiple scenarios, in your opinion, managerial involvement, what is necessary to do? What is the managerial involvement you have to give to Stefano that has to manage a project of 50 million euros? What is your managerial involvement? Maria, what do you say? What is your managerial involvement? You have two issues to manage. What do you say? You are gambling on 50 million euros, so it's fundamental to understand what you have to do to help me. Maria or other people, obviously. What is your managerial involvement?
Maybe the procedure and the progress of the research projects.
It's my job. It's my job. Because Maria gave to me 50 million euros, not because she's crazy, but because I have an incredible CV, I'm very famous, and I have a very strong equipe. Because otherwise, Maria doesn't give me money. So it's true what you say, but it's not so important. Two issues about seed financing. Two fundamental managerial involvements. Guys, the first story is a story of lobbying and networking. This is the first managerial issue, the first managerial involvement you have to give to me. For what reason? If Stefano will discover an output that can be transformed into products, I have to transform into products. I need to patent it. I need to convince corporation playing in the pharmaceutical sector to use it as a product. You understand? I can find very good outputs, but if you are not able to manage the network, and if you are not able to use your lobbying power, I'm a good inventor, you are a stupid investor, and that's it. So lobbying and networking when you deal research issue. This is the first managerial involvement, okay? Lobbying and network. Is it okay? Do you understand the game? And the second managerial involvement is fundamental. In the language of private equity investor, the second managerial involvement is called sudden death risk. You have to manage the sudden death risk. What is the sudden death risk? Just to give you the story. You give, not to me because sudden death, no. You give 50 million euros to one of my colleagues, it's better, okay? So you give 50 million euros, okay? To one of my colleagues, let's imagine we are not professors, but we stay in medicine, okay? You give 50 million euros to one of my colleagues because he wants to develop this big idea against cancer. Is it okay? So at the end of the day, you are financing what? You are financing a single man or a single woman. Do you agree? Because this man or this woman has some idea and a very strong CV. So what is your risk? The risk is a sudden death risk. You understand that you are betting on a human being. It's okay, but it's not possible. So if you want to invest in seed financing, you have to manage this issue. Ideas about that. How it's possible to manage this issue, that you are giving 50 million euros to a single man, to a single woman, to develop a research project. Ideas. Ideas about that. How it's possible to do that? How it's possible to do that?
You have to create an equipe.
Oh, I have an equipe. I work with other 15 people. I have. They are my guys, so...
Not a company, a vehicle.
A vehicle to do what? Your problem is, you understand? I have the idea in my mind, so it's very risky. Ideas. You have to create a vehicle, a new code to do what? To help, for example...
To transmit knowledge, to let the knowledge must be written down.
Solution could be very typical, for example, in Milan, what happened. For projects like that, stories are very similar in which, for example, we have men or women that would like to develop a project of 50 million euros to fight cancer, and the idea is to say, why we don't create a new co in which, okay, the private equity invests, for example, the 70%, but for the other 30%, we have 3 different hospitals in Milan. What's the rationale of it? If you have other 3 hospitals that invest in this new co, it's better for you, because the 3 hospitals help the inventor to develop the business idea, they give to the inventor an equipe which is larger, and it's possible to transfer the knowledge from a single man to an equipe and to an institution. For you, it's a completely different story than to give 50 million euros to a single man, to a single woman. You invest in a company, and in this company you have an institution that plays as subjects that can grant the development of the idea inside different equipe. That could be a solution. That could be a solution you can use to mitigate the sudden death risk, because otherwise it's a tremendous gamble to give money to a human being that has to develop a research project. Is it okay? If you are not able to do that, no lobbying, no sudden death risk because you are not able to manage it, I'm very sorry, this is a story of charity. This is a story of business angel. This is not a story of private equity. On the contrary, if you have big size, if you have multiple scenarios, if you are able to manage lobbying and networking, and if you are able to manage the sudden death risk, yes, this is a story of seed financing. Okay? Okay, guys? Take care about seed, because this cluster is incredibly increasing all around Europe and all around the world. For what reason? The reason is that governments have not yet money, and governments are not able to sustain research, so there is a tremendous need of profit investor like private equity that decide to finance this kind of cluster. So this is a story of seed financing. Questions about it? Is it okay? Let's move to startup. It's not long the story of startup, it's very simple, like early growth and expansion. Tremendous story, the story of replacement and vulture, okay? But startup, early growth and expansion are very, very simple. Definition of startup. In your opinion, what is the startup? Startup financing is the financing of the startup of the business of a company. Startup financing is the financing of the startup of a business of a company. In this case, you have the business idea, you have the business model, you need money simply, as practitioners say, to start the engine of the company. So you need capital to start the business of the company. And you need money to buy what? To buy fixed assets and working capital if it is necessary. Please remember the 4 airplanes you have to buy in the example on the Excel file. The 4 airplanes you have to buy. This is startup. Risk-return profile, a question for you, because you must be able to give an answer to me. Risk-return profile in startup is related to what? Is related to size, time, and percentage of financial need you decide to finance. Risk-return profile is related to the graph we studied today. The higher is the size, the longer is the time, the higher is the risk-return profile. On the contrary, if the size is small and or the time is not very long, risk-return profile is lower. So risk-return profile is related to the trend of the financial need we studied today. Okay? So please remember, you finance a startup on airline companies, risk-return profile is tremendously high. You finance the startup of an internet company, risk-return profile is lower. For what reason? They are both startup, but size, time, and percentage of financial need are completely different. Managerial involvement. In your opinion, what you have to do? If you give to me 50 million euros not to run a research project, but you give to me 50 million euros to buy plant machinery and inventory. What is the involvement? You don't have a problem of sudden death or something similar, okay? Managerial involvement is related to what, in your opinion? Typically, you have two different issues which are quite important. First of all is transfer of managerial capabilities. Transfer of managerial capabilities. I am the start-upper, I am a very good entrepreneur, but in the startup, probably, it depends from the story, but probably I don't have managerial capabilities, or I do not have money to develop managerial capabilities. Examples: I create a startup, I'm a good entrepreneur, but I don't have people devoted to marketing and sales and people devoted to human resource. I don't have, because I am an entrepreneur, an inventor. So the first involvement of the private equity investor is to help me to scout and to recruit people for these kind of functions in the company. Transfer of managerial capabilities. And second, the second involvement is to give to me, to provide me the entrance to your network, to give to me the possibility to enter your network in terms of customers and suppliers. If you stay in the startup, a fundamental role for the private equity investor is to help me, come back to the example of the airline companies, to help me to go together to Airbus and Boeing, and you negotiate the pricing of the airplane for me. What is the impact? You are able to reduce the capital intensity and to increase the cash flow. That's great. Or you give to me the access to your network to multiply customers. What is the impact? To reduce the time of the financial need. Okay? But please remember, in any case, the private equity investor gives to me help and support on entrepreneurial issues. I am the entrepreneur, you are the financier. And you don't act as an entrepreneur, because I am the entrepreneur. I have to manage. Okay? Is it okay, guys? Early growth. What is early growth financing? The definition, the formal definition, is not so interesting, because the formal definition of early growth financing is the financing of the very, very first phase of growth of sales. So early growth financing is the financing of the very first phase of growth of sales. Okay. But in my opinion, it's better the definition which is given by practitioner, where practitioner says the early growth financing is the financing of the day after. What does it mean is the financing of the day after, in your opinion? You start a company, you have a business plan, and the day after, when you start working, you will discover that the real world is different from the business plan. It happens always. But if the real world is different from the business plans, what happens? In some cases, nothing, because the real world is better than the business plan. But if the real world is worse than the business plan, the problem is that you have a higher financial need. And if you have a higher financial need, you need to finance it. Okay? If this need of financing is not tremendous, probably you can go to the banking system and you say, dear banking system, can you give me money to finance the working capital? And the answer could be, okay, Stefano, we will give money to finance the working capital. But if the size of the financial need is very big, you cannot go to the banking system and to say, I would like money, because the banking system will say, Stefano, the amount of money is very huge, it's very big, it's better that you come back to the private equity investor. Okay? So this is a specific role of private equity investor. Also in this case, the risk-return profile is again related to the graph of financial needs. Again is related to size, timing, and percentage of financial share, of financial need you decided to finance. Okay? Managerial involvement. What is the managerial involvement in early growth? The fundamental managerial involvement in early growth is to help the company to revise the business plan. The fundamental managerial involvement is to help the company to revise, to write again the business plan. Do you understand the story? I started my company the day after I discovered that the trend of sales is completely different. I need additional money, but not simply. I don't simply need additional money. I need what? To write again the business plan. Because if the real world is different from my previous assumption, probably my business model, my positioning is not right. So fundamental involvement coming from the private equity investor is given through a very strong help to write again the business plan. But to write again the business plan, it's mandatory that the private equity investor knows very well the business in which the company stays. If I stay in the chemical sector and the private equity investor doesn't know anything about the chemical sector, I'm very sorry, but you are not the private equity investor, which is helpful for me, because you must help me to write again the business plan. Okay? For this reason, we will discover when we discuss about strategy, in early growth, we find all around the world a lot of private equity investors which are focused into some specific sectors. So we find private equity investors devoted to IT, private equity investors devoted to biotech, private equity investors devoted to lasers and sports, and, okay, focused on some specific sectors because of this need to revise the business plan. Expansion financing. Expansion financing is the easiest job of private equity. For what reason? Definition. Expansion financing is simply the financing of sales growth. Expansion financing is the financing of sales growth. And to finance sales growth means to finance working capital and or additional investment. Why is the easiest job, in your opinion? Why is the easiest job for a private equity investor? Expansion financing. Why? The first answer is because in this graph, you are very close to the break-even, because the company stays in expansion. Okay, this is the first answer. But we have also another answer, why it's a very easier job. Expansion financing.
Because you have collateral.
Not exactly. Implicit collaterals is the same of the answer of your colleagues. That means you are very close to time zero, so positive cash flow are very close to now, so the risk is not high, but it's another story. It's a very easy job, because the same job can be managed by the banking system. If you have to finance simply the growth, that means I need to finance the working capital and or additional investment, the same job can be managed, can be played by the banking system. Okay? So it's a job of a pure financer, because simply you have to give money to a company which doesn't stay in startup and early growth, so the company is developing well, and you have to give money in a specific issue, on a specific issue. And the specific issue is a need for money coming from the working capital, or a need of money come from additional investment. Expansion financing is really the easiest job of private equity, and in this cluster you will find a lot of competitors. For what reason? Because also newcomers, also very small boutique of private equity start working in expansion financing, because the job is very easy. You have simply to give money for working capital, additional investment, and that's it. And risk-return profile is very low, okay? Because you stay in competition with other financiers like the banking system. Managerial involvement? No one. You are giving money to the company. That's it. Because you are financing a specific issue. Okay? I do hope, I know you want to have a lunch, but I do hope, it's obvious, it's clear that moving from seed to expansion, the risk-return profile is falling down. Okay? There is a logical trend coming from seed to expansion, because moving from seed to expansion, the risk is falling down, but also the return is falling down. Okay? In order that you remember numbers, a classical, a typical return of seed financing is 250%, but please remember a lot of bad stories and defaults. And the classical or a typical return in expansion is 7%. For what reason? Because you are the same as a bank financer. It's the same like loans. I give to you money because you have to buy inventory. That's it. Okay? But you can imagine also the story of risk is completely different, because the risk of failure is tremendous in seed. The risk of failure is in expansion is very close to zero. Okay? Now we have the two last clusters. I would like that you understand that, please take care, the story of this graph comes to an end to expansion. So replacement and vulture are two different stories which are not related to the graph. Okay? Replacement and vulture are not related to the graph. Let's start from replacement. Definition. What is the definition of replacement? The definition of replacement is not satisfactory, because the definition is stupid and simple. Replacement financing is the financing of a mature company. Thank you very much. Okay. I would like to understand why a mature company needs money. And we have two different stories, two different options, two different possibilities why a mature company needs money. The story number one is called story of growth and acquisition. And the story number two is a story of turnaround. So we have a story of acquisition, and we have a story of turnaround. These two stories are so different that from a logical point of view, it's enough to say that replacement financing is not a cluster, but is a cluster divided into two parts, okay? So if the words would be designed from professors, I can say, dear guys, the cluster are 7, because turnarounds and acquisition are so different that they are two clusters. But practitioners in every part of the world love to say, no, it's the same cluster. So, because I do prefer to give to you the sense of the real world, it's better to say, okay, replacement is a unique cluster, but take care, because inside we have two different stories. The story number 1 is a story of acquisition. The story number 2 is a story of turnarounds. I would like to specify better what it means, a story of acquisition and a story of turnaround. Okay? Take care, because the replacement is the big cluster, so 50% of the market, so it's quite important to discuss about replacement. What is the story of growth and acquisition? The story is very simple. I come back to Maria, okay, and I say, Maria, I have a new deal, okay? You know, I manage a company which is mature, so I don't need money for startup, for financing growth, because I use banking system. Don't worry. I have a completely different problem. I would like to buy one of my competitors. I would like to buy the company of Antonio, okay? For what reason? Because I would like to grow, okay? And I say, Maria, I need 50 million euros to buy the company of Antonio. And I don't need simply your money, but absolutely I need your help to negotiate with Antonio and to arrange the deal of acquisition. Okay? You understand the story? In some cases, I don't have any idea of the company of Antonio. Because if I say, Maria, I would like to enter the Brazilian market, and to do that, I would like to buy a company operating in Brazil, but I don't have any idea about the names of the company operating in Brazil. You can do that for me? You go to Brazil and you scout and you say, absolutely, Stefano. Absolutely. I go to Brazil. It depends from your network you have. And if you discover a target in Brazil, you come back and you say, Stefano, I identify a target for you, and I give to you 30 million euros to buy the company of Antonio that I don't know, but you screened before, and I decided to buy it. Okay, guys? This is the story of acquisition. But there is also another story, and this is a story of turnaround, a completely different story. What is the story of turnaround? I would like to give you a very nice example. It happened to me 2 years ago, like an advisor of a fund. It's a very simple story, but quite representative of turnaround. This is a story of an Italian company, but doesn't matter it is Italian. It could be a European company, okay? This is a big companies, okay? With a very high profit, no problem of liquidity, no problem of acquisition, because the company is very big, but the problem is completely different. The problem is the following. The CEO of the company, which is the main shareholder, is 78 years old. Okay? Very common in Europe. Okay? This founder has 2 daughters. Okay? The 2 daughters are completely different. The daughter number 1 is quite smart, like the father. The daughter number 1 is working the company, and obviously, he would like to become a new CEO. The other daughter is completely stupid. She's not involved in the company. She spends a lot of money. Okay, this is the story. Okay? But there is another problem, that the 2 husbands are exactly the opposite. I'm not joking. The smart lady is married with a very stupid husband, okay? He doesn't work and he wants to spend money, but this is not relevant because the smart lady is able to manage the stupid husband. It's a classical story. But the other case, it's difficult because the stupid daughter married a very smart husband, and the smart husband is the CFO of the company. And the other problem is that the first daughter has 2 very small sons, and the other has 3 small sons. What happened? What happens is very simple. One day, this founder discovered to be very old. It happens, okay? Because he had a problem. He had to go to the hospital for 1 day. And he realized that I'm very old. But what I have to do? I'm 78 years old. I start negotiating with, I'm 78 years old, I start to negotiate with my 2 daughters. And I have to say to the daughter number 1, don't worry, you are the best, and you will become the CEO. And I have to say to the other, you are stupid, and you have to exit. I perfectly know, but it's too late to do that. You understand? And too complex now. Okay? What we can do? We have 2 options, 3 options. The option number 1 is, I don't do anything, and it will be the disaster. But I'm quite wise, and I can say I have 2 options. The option number 1 is to give a call to a consultant and to say, Stefano, please come in, or Mr. McKinsey, come in, you have to solve the problem. Wow, I'm here. I prepare for you 200 pages of slides in which everything is written. I ask to you €500,000 for the consultancy, and I say you have to apply. Okay? The other story is the story of this course. I give a call to a private equity investor, and I say, dear Stefano, there is a tremendous problem. There is a mess. If you want, I give to you the 30% of shares of my company. Okay? I give to you 30%. And now, welcome in my company. You stay in the board of directors. You are 30% of, you have 30% of shares. You want to have the capital gain. You have to solve the problem. For me, it's not a problem because I'm 78 years old. You have to discuss with the 2 daughters. Please, you can do that. You want to discuss with the 2 husbands? You can do that. You don't do that, no money, because now you are shareholders, you understand? You are a consultant, but you will be paid by a capital gain, not by my money. You are not able to do that, your reputation is completely destroyed. Because tomorrow morning in Italy, everybody will know that you are not able to do the job. The turnaround story, okay? Completely different story. What I would like to do, and to say, only 1 minute, the turnaround story is the story nowadays in Europe. Because from a statistical point of view, in Europe we have a lot of companies in which the entrepreneurs and the founders are very old, and it's time to launch a turnaround. So it's really, really the business nowadays in Europe, not only in Italy, but in many countries in Europe, this is the business. And it's not a game of money. It's a more tricky game of consultants, of corporate governance, and capability to identify very, very glamorous solution to solve very difficult problem of succession inside companies. Okay? So, we stop in this point. I have to use more or less 10-15 minutes of the lesson number 4 to come to an end of this part. And in the next lesson, tomorrow, we have to start to discuss about the legal framework of private equity. But we have to use 10-15 minutes to come to an end of this part. So see you tomorrow.